Hello, this is Gary Schnitkey, and this is a 5-minute FarmDoc Daily dealing with crop insurance, marketing, and farm incomes at the beginning of July 2023. The growing season up to this point has been dry across much of the Midwest. If we look at weather in May and June, we have seen very little rain. The Drought Monitor on June 27th reflected that fact, and we saw much of the Midwest in dry or drought conditions. That drought monitor was eerily similar to the 2012 drought monitor at the same time, our last big drought year. However, over the past couple weeks, most of the Midwest have received significant amounts of rain, with some areas or most areas receiving over 2 inches of rain. That will help immediately with crops. However, when the drought monitor came out on July 4th, 2023, it still had a large part of the Midwest in drought. We saw actually very little improvement from the week before the drought monitor to this week's drought monitor. The reason for that non-improvement is that much of the Midwest is still deficit in rainfall. If we look at rainfall over the last 60 days, most areas are over 2 inches in deficit, with some of those up to 4 inches in deficit, a month's on average worth of rain in certain cases. Those rains that received over the last week of June, first week of July, helped get the crop going again, but we will continue to need rains moving forward. As we look at what has happened to corn prices as a result of recent conditions, we saw corn prices average $5.92, and that would be the December contract on the Chicago Mercantile Exchange, $5.92 in February. Since that point in time, we have seen that price slowly drift down to about $5 in May. We then saw that price increase, and it's increased significantly in the latter part of June, again on drought concerns, reaching over $6.30. However, after those rains went through, we saw those prices fall, and new crop prices and that December contract are now back to that $5 level. It is like the market has eliminated the chance of a large-scale drought in 2023. That may be true, but there is still a significant chance of much lower than trend yields because we will need continuing rains to reach that trend yield level. If we're looking at prices right now, and particularly corn prices and where those December contracts are, if an individual has purchased a 85% RP policy, that policy is in the money, so to speak. We don't need to see any further price declines for that crop insurance product to pay if yields are at the guarantee yields or lower. That causes new crop sales of crop to have limited value from a risk management standpoint. If we're concerned about reducing risk, a better area to focus on would be soybeans. Soybean prices are still well above the trigger levels on RP products. We have simply not seen the declines in soybean prices like we have seen in corn prices. Overall, as we're looking at farm incomes for right now, the drop in price brings us back to our original forecast for 2023. We're projecting an $81,000 net farm income for 2023, and that would be an average of FBFM farms, with that farm size being roughly 1,500 acres. That $81,000 per farm is roughly equal to the average from 2014 to 2019. A not particularly high income period in farming. It would also be below that $81,000 the last 2 years when we saw near record incomes on Illinois grain farms. Overall, we're looking at 2023 being a lower income year than recent years, and the recent declines in corn prices contribute to that continuing $81,000 per farm projections. You can read more about this in the FarmDoc Daily, listed in the video description.